The U.S. tax code runs about 7,000 pages, and do you know how much of that is really about telling you what you owe? Very little. Most of it is not punishment. Most of it is instruction. It is the government saying in plain English, if you know how to read it, here are the things we need built. Here are the things we need funded. If you put your capital there, we will reward you housing, energy, infrastructure, technology, productive assets. The government cannot build enough of these things on its own, and it knows it. So it does the next best thing. It uses the tax code to bribe private capital into doing the work. That is what I want people to understand. Most people look at taxes and see a bill. Investors look at taxes and see a map. The code is not some giant list of loopholes rich people invented in a back room. The code is a public incentive structure. It tells you very clearly what the government wants from its citizens. If you produce, if you build, if you invest in the things that expand GDP, energy, housing, industrial capacity, and productive output, the government often gives you part of the money back. Not because it loves you, because it needs you. That is the real frame. The government wants jobs created. It wants tax revenue later. It wants energy produced. It wants technology funded. It wants housing built. It wants infrastructure in the ground. It cannot create those things the way private capital can. So it tells you, go do it and we will help. That is why the tax code is written the way it is. And almost nobody reads it that way. They just see withholding. They see April. They see whatever number the accountant tells them. Then they move on. They stay on the consumer track their entire lives and wonder why the code never seems to favor them. It does not favor them. That is the point. The tax code was not written for consumers. It was written for owners. There are really two tracks most people live on, whether they realize it or not. The first is the consumer track. You go to school, you get good grades, you get a job, you earn money. The government takes its cut first. Then you live on what is left. Maybe you save a little, maybe you invest what survives after taxes and bills. That is the default path. It is also the punished path. Because in that framework, you earn first, get taxed first, and invest with leftovers. The second track is the owner and investor path. On that path, the code starts behaving differently, because now you are putting capital into the exact things the government wants more of. That is when the incentives show up, depreciation credits, accelerated deductions. Structures that make the same dollar behave very differently simply because of what you did with it. That is why I always tell people the tax code is not anti-success. It is anti-passivity. If you only consume, it punishes you. If you build, own, and invest in the right areas, it starts working with you. Now let me explain the mechanism, because this is where people get confused. Most people hear tax write-off and think that is the whole game. It is not a write-off. It is ordinary and often overrated. If my business spends $1 on a legitimate expense, sure, I may not pay tax on that dollar, fine, but I still spent the dollar. That is not what excites me. I do not get excited spending $1 to avoid paying tax on $1. That is not a wealth system. That is just expense management. What matters here are two other tools, depreciation and tax credits. Those are the gears that make the real machine work. Depreciation exists because the government recognizes that productive assets wear down, get used up, get replaced, or have a finite useful life. If you buy equipment, real estate improvements, energy systems, and certain other qualifying assets, the IRS allows you to depreciate that asset against income. And in many cases, because of bonus depreciation or accelerated schedules, you can pull a huge amount of that depreciation forward into year one. That changes everything. Because now you are not just reducing taxable income slowly over time. You are pulling a future tax benefit into the present. And when you stack that with tax credits, it gets even better. A deduction reduces taxable income. A credit is usually even more powerful because it offsets tax liability more directly. That is the distinction people miss. The goal is not merely to spend and deduct. The goal is to acquire productive assets in ways that let the tax code partially or materially fund the acquisition. That is where the magic starts. And then there is one more layer. Other people as money. I want you to understand this clearly because this is the part that separates casual tax talk from a real wealth system. If I buy a qualifying asset, I often get to depreciate the full purchase price regardless of whether I paid cash for it or financed it. That means I can borrow to buy the asset, still get the depreciation benefit, and use the tax savings to help offset the economic cost of the asset. That is a very different game from simply paying cash for things and hoping a deduction softens the pain. This is why I prefer borrowing to acquire productive assets when the structure makes sense. Not mindless borrowing, not stupid leverage, productive leverage, because the depreciation is attached to the asset, not to whether I use my own cash or the bank's cash to acquire it. Now let me give you 4 examples from the source material, because these are the concrete plays where the government is effectively paying people to invest in 2026. These are not the only ones, but they are good illustrations of how the code really works. The first one is Bitcoin mining equipment. This is one of the more unusual ones, and it also happens to be one of the more interesting because it combines technology investment, bonus depreciation, and an asset that produces another asset. When you buy Bitcoin miners, you are buying equipment, real machines, real hardware, under the relevant tax treatment. That hardware can qualify for accelerated depreciation in the framing of the source material. That means you can acquire the miners, take a large depreciation hit right away, and then the machines begin producing Bitcoin. That is the part I like. I do not just want the deduction. I want the deduction tied to an asset that generates something every day. So imagine you have $150,000 in taxable income you would otherwise pay tax on. You acquire $150,000 worth of qualifying mining hardware, ideally with financing or borrowed capital rather than your own cash if you can structure it intelligently. You use the depreciation to offset that taxable income. Now, instead of that money disappearing into taxes, it is attached to equipment that sits there and produces Bitcoin. The tax benefit helped fund the acquisition. The acquisition now produces an asset. And if the economics of mining remain favorable, the asset keeps paying after the first-year tax benefit is over. That is what I mean when I say I want the government to help me buy an asset that then helps me buy more assets later. That is not a write-off. That is a flywheel. Now, this is not for everybody. You have mining difficulty, you have Bitcoin price risk, you have hardware issues, you have hosting and operational questions. So I am not pretending there is no risk here. I am saying the structure is powerful because a productive machine got partially financed by the tax code and then continues producing scarce digital property after the fact. The second play is real estate. This is the classic, but most people use it too slowly. The standard story is that you buy residential rental real estate and depreciate the building over 27.5 years. That is fine, and many fortunes have been built that way. But if you are only dealing with a couple of properties, a slow depreciation drip may not move the needle enough to matter dramatically in year 1. That is why cost segregation becomes so important. With a cost segregation study, specialists reclassify parts of the property into shorter life categories: fixtures, flooring, appliances, certain improvements, components that do not need to sit inside the 27, and a half-year bucket. Then you accelerate that depreciation so much more of it comes forward into the first year. That is where the strategy gets interesting. And if you combine that with the right type of property, the economics improve. Again, you want the value to be in the building, not mostly in the land, because land does not depreciate. So in lower cost markets where the building allocation is high, your first year depreciation can be much more powerful than in high. Coastal areas where a larger share of the purchase price is really land value in disguise. Now, there is an important nuance here for many W-2 earners. Traditional rental losses may not offset ordinary earned income the way they hope, unless specific real estate, professional or short-term. Rental rules apply, that matters, but the broad structure still matters, because once you qualify to use it appropriately, the tax savings can help fund the down payment or materially soften the capital you had to commit, and then you still own the asset, you still own a property that can appreciate, you still own a property that can generate rent, you still own something tangible, financeable, and productive. That is what I love. I do not want the tax benefit alone. I want the tax benefit attached to a compounding asset. That is the whole philosophy. The third play is oil and gas. This one has existed for a long time, and the tax code has favored it because energy production is politically and economically important. When you invest in certain drilling programs, a very large portion of the capital can be treated as intangible drilling costs, labor site preparation, fuel, the messy costs of getting the well operating. In many cases, those costs are deductible immediately. That is powerful. So if you put $50,000 into an oil and gas program and 75 to 90% of that qualifies the way the source material describes, then a huge portion of that can come off your taxable income right away. If you are in a high bracket, the tax savings can be material, and then again you still own the underlying economic interest. You may receive royalties if the wells produce, so you are not simply buying a deduction. You are buying a tax-favored claim on future energy cash flow. Now, I want to be careful here too. This is not clean and simple. You are taking commodity price risk, operator risk, production risk, and all the mess that comes with the oil and gas business. But from a tax architecture point of view, it is one of the clearest examples of the government saying, we need more energy. If you help fund it, we will make that attractive. That is the message embedded in the code. The fourth play is solar. This one is perhaps the most explicit, because solar can pair depreciation with a direct credit. And when you stack a large credit with accelerated depreciation, the first-year economic effect can become very strong. Take a hypothetical $100,000 system. The source material describes a 30% tax credit. That means $30,000 directly offsetting taxes. Then you may be able to depreciate much of the remaining basis as well. Stack the two together, and you can have a very large percentage of the capital returned in year one through tax mechanics. And again, the system is still there afterward. It still produces. That is what matters to me. A credit alone is nice. A credit tied to a productive asset is a system, because once you own the solar asset, it can keep generating value through energy economics, through commercial usage, or through the broader structure in which it sits. And now we arrive at the most important idea in the whole source material. These are not isolated tricks. They are connected. That is the real shift. Most people think tax strategy is about one-time optimization. Save some money here, claim a deduction there, maybe reduce the bill this year. That is not how I think about it. I think about it as a loop. I take money that would have gone to the government. I redirect it into a qualifying productive asset. The code gives me depreciation, credits, or both. That tax benefit softens or partially funds the acquisition. The asset now produces income, appreciation, or some other valuable output. Then that growing asset base gives me more borrowing capacity, more income, more scale, and in many cases more tax planning room the following year. Then the cycle repeats, the refund gets reinvested, the asset base gets larger, the production base gets larger, the depreciation opportunities get larger. And over time, the balance sheet begins compounding in a completely different way than it would have on the ordinary consumer track. That is the flywheel. This is why two people with the same income can have completely different financial outcomes over 20 years. It is not always because one earned radically more. Often it is because one ran the money through the consumer system and the other ran the money through the investor, owner system. Same income, different code path, different outcome. Now, I want to be honest about something. This is not beginner level financial life. You do not blindly buy miners, oil wells, rentals, or solar arrays because some guy on the internet said the government will pay you. You have to know what your taxable income is. You have to know your marginal tax rate. You have to know whether the depreciation is usable for your fact pattern. You have to know the economics of the asset itself. And you need competent tax advice from someone who understands strategy, not just compliance. That last point matters a lot. A lot of accountants are historians. They tell you what happened. That is useful. But if you want to actually build wealth through the code, you need someone who understands what the code allows before year end, not just what got reported after the year is over. That is a different level of thinking. and that is why most people never do any of this. They are consumers by default. They earn, they get taxed, they spend, they save what survives, and they assume that is just how money works. It is how money works for consumers. It is not how money works for investors. The consumer sees a tax bill and resents it. The investor sees the tax bill and asks a different question. What does the government want funded badly enough that it is willing to help me own it? That question changes everything. Now, there is one more thing I want to say because it sits underneath all four of these plays. The goal here is not to avoid taxes by doing stupid things. That is how fools get themselves into bad deals and then blame the tax code for their own greed. The goal is to acquire productive assets that you would want to own anyway. While using the code to dramatically improve the economics of ownership, that is the mature way to do it. If the asset is bad, the tax treatment will not save you. If the operator is bad, the deduction will not save you. If the financing is stupid, the structure will not save you. The code rewards productive activity. It does not repeal economic reality. So here is the simplest action step. Look at what you expect to pay in taxes this year. Then ask yourself a very different question than most people ever ask. If that money did not go to the government, where could I put it into a productive asset the government wants funded anyway? Bitcoin mining hardware, real estate with cost segregation, oil and gas, solar, maybe something else entirely. Then ask the second question. If I redirect that money into a productive asset, and that asset compounds, what does that look like over 10 years, 20 years, 30 years? That is when the math gets exciting, because taxes are not just a bill for owners. Taxes are a capital allocation problem, and once you see them that way, the tax code stops looking like 7,000 pages of punishment. It starts looking like a set of instructions. Most people never read the instructions. That is why the code feels unfair to them. Owners read it differently. That is why it works for them. And if you learn to read it that way too, the government will not just take your money. In many cases, it will help you build with it.